Despite elevated levels of uncertainty, the U.S. economy continues to be in a good place. The labor market is solid, and inflation has moved closer to our 2% longer-run goal. At the Fed, we are intently focused on our dual mandate goals given to us by Congress: maximum employment and stable prices. Turning to the recent data, the economy has been growing at a solid pace. GDP expanded at a 2.3% annual rate in the fourth quarter of last year, extending a period of consistent growth that has been supported by resilient consumer spending. Recent indicators point to a possible moderation in consumer spending relative to the rapid growth over the second half of 2024. Further, recent surveys of households and businesses point to heightened uncertainty about the economic outlook. It remains to be seen how these developments might affect future spending and investment. Sentiment readings have not been a good predictor of consumption growth in recent years.
Coming up today, stocks finished their worst week in months. A look at the jobs report, the messaging from Jay Powell, worrying words from Besson. Is the AI trade moving to China? And why I still think this is a buy the dip opportunity. You don't want to miss this one, guys. Let's go. And welcome back, everybody, on what was a slightly positive finish to one of the worst weeks we've seen in months in the market. A little bit of a bounce back in the growth trade today, but still plenty of weakness out there in financials and a few consumer discretionary stocks out there today. And to switch in the heat map over to a weekly performance, we can see just how hard some growth names got hit. Nvidia off almost 10%, even the previously strong leader Meta down over 6% for the week. Netflix and Disney as well. Tesla down over 10%, Amazon, and some of the financials getting hit pretty hard this week as well. But stick with me today because I'm going to show you why I think we could be at a bit of an inflection point in this monster move of late. Got some key reversal signals all over the place. And if you're new here, welcome. My name's Jared. I make these videos every day after market close. So if you want to stay up to date on everything happening with stocks, smash that subscribe button, and a huge shout out to all my regular viewers for hitting that like button. And diving right in, we've got the fear and greed index still in extreme fear zone at 20. A lot of investors still on edge, really nervous about all these news of tariffs, headlines of a recession, potential stagflation, and we're still in the thick of this pullback. Going to show you later on the charts why we're still in the dicey zone, and we didn't quite hit a 10% correction on the S&P, even though we have well and truly on the Nasdaq and the Russell 2000, and especially the growth and momentum trade. Small cap growth and other hot stocks having significant corrections these last couple of weeks. But just looking back in history at the S&P 500 at all 10% corrections, and looking at this one that started on the 19th of February, what you'll notice is if we do get that 10% correction, it can happen quite quickly, with a lot of them occurring within the first 30 days here. And most years we do get a 10% correction, so if the S&P 500 is going to do its 10% correction for the here and now, it very well could have one last sharp spike on the downside next week. If we didn't already see the low today, which I think there is a reasonable chance as well. Again, I'll explain my reasons later on the charts. But just looking at some seasonality, we can see a bit of a pullback in the first 2 weeks of March. Before the market will quite often find its lows, then the second half of March going into April and May tends to do a little bit better. And it's really been a sharp pullback in the broader market. Looking at the Russell 2000, we've just done 6 consecutive down weeks. It has never gone further than that this entire century. And just looking at the Russell 2000 daily chart here, if we were to finish next week lower, that would be the first time in over 25 years we've done that. But like I said, we are getting some key reversal signals here, very stretched and looking quite oversold here. Other sectors as well, retail, starting to look like a potential bottom. Buy signals, hammer candles, a lot of volume occurring. This is typically what technical bottoms look like. And we're getting this pattern in a lot of sectors, oil and gas as well, along with discretionary stocks, putting in a nice hammer candle formation there today. Kind of similar to the S&P 500 itself, looking at the SPY, just going down to a 5-minute chart here. Market was whipsawing all day, coming into the regular open, sold off into lunchtime, found its feet, and kind of ripped back up into the close, which I guess is a good sign going into the weekend. The market quite often this year has taken risk off going into the weekend due to all the headline risk. And just looking at some key stocks, Nvidia also showing potential signs that we could be close to a bottom. Hammer candle formation and reversal signals, which have a very high accuracy rate on a winning stock like Nvidia. And I believe the fundamentals are still accelerating for Nvidia as well. We just heard today, Elon Musk's AI company XAI acquires a 1 million square foot property in Memphis to host infrastructure to complement their existing Memphis data center they use to run Grok 3, which I'm now using more than GPT. It's much faster, much more detailed response, and much less woke filters as well. Get a much more clearer answer from using Grok 3. Recommend it to anybody who hasn't tried it yet. Their existing facility, already running 100,000 GPUs, they want to up that to 1 million Nvidia NVIDIA GPUs by the end of this year. That's a pretty big order. Top of that, we just heard today, OpenAI, the company behind GPT, and other Stargate partner Oracle need to re-up on NVIDIA chips as well as part of their $100 billion Stargate infrastructure venture they announced a month ago. So to my eye, it still looks like there's a big compute power arms race with NVIDIA, the biggest picks and shovels supplier of it. They have around 90% market share of high-end GPUs. Meta's also going to be up there, ordering hundreds of thousands more GPUs as well. Looking at my fundamental indicators, it's got fair value around 145. However, with an exceptional stock, brand, near monopoly on high-end chips, I would happily give it a 30% premium, meaning I think the current fair value on Nvidia is closer to $200, and hence why I'm looking to buy it down in the low 100s, because in my mind, kind of like buying $1 for 50 cents. So if I can pick up a few shares for $103, I think that is a great opportunity for my long-term portfolio. Could also make for a good short-term swing trade as well, buying the dip, playing it back to this yellow line, the 50-day VWAP, which is one of my 28 custom indicators. And in addition to these reversal signals, we've also got some bullish seasonality coming into Nvidia over the next couple of weeks and couple of months as well. And so this indicator looks at how the stock performed in the past over the same time period going forward. And you can come up here and adjust the look back period along with the forecast days, giving you 5 different forecasts. And if you'd like to get my seasonality forecast indicator 100% for free, then just click the link below this video or head straight on over to my website, clickcapital.io/free. Just enter your email, TradingView username, and give us a few hours and you can get this indicator free for life in your TradingView account as well. I and many others use it every day to help us pinpoint trading opportunity. So I highly recommend getting this indicator if you haven't already. And it's moving on to the other most popular stock in the market, Tesla. 1, 2, 3, 4, 5 reversal signals, something we haven't seen for a long time. Not since the stock last bottomed in late 22. Plenty of negative sentiment and headlines being smashed with the stock. Media keeps trying to manufacture controversy around Elon Musk's much needed work for Doge. But just stepping back and looking at the actual numbers, we just got news yesterday. Tesla UK sales up over 20% year over year, despite the so-called Elon Musk backlash. As apparently a lot of Europeans are upset with Elon Musk trying to clean up government spending in the United States. Makes sense, right? But I agree with the fellow perma-bull, Dan Ives. This sell-off is an opportunity. Years from now, this is going to be a generational opportunity. Based on our survey work, we think less than 5% of Tesla owners will think twice from a brand perspective because of Musk. From talking to people at Tesla, I actually think he's driving a lot of the bigger initiatives at Tesla, despite the view that he's 110% into Doge. So no doubt there is a few people out there that are upset with what Elon's trying to do and maybe won't buy a Tesla. So be it, but I think most people don't really care. And the fact is we've got the new Model Y starting to get delivered in Europe today and about to hit the streets in China as well. A very big, important market. A lot of Western companies don't really have a strong presence in, nor are they welcome there. Tesla is. Another big reason why I believe they deserve a premium valuation. Just looking at a local Chinese news site, Tesla's new Model Y has quickly gained traction in China, racking up 200,000 orders since pre-orders began on January 10. A lot of people don't realize the Chinese love Tesla. They know it's a quality-made American brand. A lot of people forget about Tesla's massively growing energy storage business, Megapacks, building the world's biggest battery storage facilities around the world for both the private and the public sector. Growing leaps and bounds here. This isn't revenue, this is gross profit by quarter. Last quarter alone, just the energy and storage segment on its way to producing $1 billion per quarter in gross profit. And look at that growth. Just a couple of years ago, it was below 100 million. Companies that can do this and big future industries deserve a premium valuation. Too many investors invest in stocks looking backwards. It's like driving looking in the rearview mirror. You got to drive looking out the front windscreen. And anybody who wants to doubt the man behind the greatest engineering feat in our lifetimes will just end up like most bears and lose money, just like I've seen since 2010. And I'm sure we'll be sitting here in 2040 with the same amount of hate and criticism. And just looking at some of my other technical indicators, institutional buying now really high, almost 68. That's higher than back what we saw on the 22nd of October and there in the middle of August. That was the last time back then, 22nd of October and back here as well. So technically it's looking really oversold to me. And like I said, the fundamentals are just so good on the stock. Just looking at a weekly chart here. If we draw a Fibonacci from this entire move up from April last year to December, we're pretty much sitting smack bang in the golden pocket around that 65% retracement. And it has been a big, pretty much 50% pullback from highs. So I believe we're closer to a bottom than a top for Tesla. And like I said, the fundamentals are just stacking up here. Robotaxi's only months away from coming online. Beginning first in Austin in July. Full self-driving only just entered China. Really good feedback feedback coming out of there. The new Model Y is being produced at all 4 gigafactories. Deliveries just starting to roll out around the world. Initial good signs from China. Got cheaper, more affordable models on the way. New semi-production. A third Megapack factory going to be built in Texas. Making inroads into the Indian market. Cybertruck, the best-selling electric truck. Doubling down on Doji, massively expanding their compute power. Probably going to collect more real-time data than any other company in the world. And let's not forget, they plan on building thousands of Optimus humanoid robots this year to work in Tesla factories. Next year, they plan to 10x that number and sell them to other companies as well, and hopefully consumers. And so I get it. I understand Musk is a controversial character. For whatever reason, some people hate him, and Doge could very well be perceived a distraction, but he seems to have a knack for time management, given the fact he overlooks a dozen projects, he has large and capable teams, he works around the clock all day, and I continue to believe that him being best friends with the President of the United States will be beneficial to Tesla shareholders in the long run, and will help create a deregulated environment for autonomous vehicles to take off and be integrated into society with Tesla, the leader. I just bought the dip a few days ago, added to my long-term position, and I'll do so again at $2.20 a share if we get down there over the coming days and weeks, which again, I believe will be another great level to pick up a few shares of Tesla. But just moving on to the macro for a minute here. It's the first Friday of the month, so we got the jobs report. Came in a touch softer than expected. Was probably kind of in the sweet spot for the market today, because if we came in too soft, would have been a further economic growth scare. If we came in too hot, the market would have to dial back probabilities we're going to get a Fed rate cut. So that's kind of the sweet spot here at 151,000 versus 160 expected. Slight little uptick in the unemployment rate, 4.1. Again, I think it's kind of the sweet spot, and a little miss on average hourly earnings, but still a good number, 4% year over year. And so let's just look at the hard data. So there we are, 151,000 new jobs created in the US economy in February. Not the best, but definitely not the worst of what we've seen over the last year. In fact, 1, 2, 3, 4, 5, 6 months came in lower. So we're in the top half of results there. Just going out to a 3-year chart, still kind of just bumping along, basing along here. And like I said, still holding up good is the growth in average hourly earnings, 4% year over year. Again, much better than some prints we've seen over the past year. And just going out to a 5-year chart, and even further, a 10-year chart, one could argue that's in a pretty strong uptrend. Had plenty of volatility in the data. Coming out of 2020 and 21, like we saw all over the place, but for the here and now, things are holding up pretty good. Just as Jay Powell said, jobs market's okay, the economy's okay, but consumer sentiment confidence is a bit low, but that doesn't necessarily correlate with their future spending. It's more their feelings, which we're not surprised with all the headlines they're getting smashed with. And just looking at the SAM rule, recession indicator, for those of you who don't know, this has a strong track record of signaling the start of a recession when the 3-month moving average of the unemployment rate rises by 0.5 percentage points or more relative to the minimum of the 3-month averages from the previous 12 months. And so just going down to a 1-year chart, we're currently at 0.27. Sure, some of you remember mid last year, this went above 0.5 and we had plenty of headlines and rhetorics that we're already in a recession. It's right around the corner. We need emergency rate cuts. Didn't quite turn out that way. And we've actually turned down sharply since then. And even Claudia Sahm, the economist who created this indicator, said herself things could still be normalizing after 2020. And just looking back prior to other recessions, you can see every time this indicator was sharply climbing going into recessions. We just don't quite have that right now. Not to say that it's not possible, but like I said, you can theorize over anything. What we like to do here is follow the data and trends. And as we've been saying, the Fed is still trying to work out everything from this new admin, I guess, with the rest of the market as well. A lot of big global investors, institutions doubting Trump and his team, pulling money out of American markets to invest in European and Chinese assets, while we've seen some weakness in the dollar. Plenty of noise out there. And just like we do here, Jay Powell also trying to focus on the signals. And as we've been saying, probably going to wait for the dust to settle on this tariff storm before giving indication on his next move with monetary policy. But this could be a repeat of September last year. Yields come off, the market gets a little bit weak, headlines, gets Jay Powell to do a cut. And in fact, new Treasury Secretary Scott Bessent could be trying to prompt that as well. It's not often you see a Treasury Secretary, someone so high up in the government, come out and say the economy could be starting to roll over a little bit. Might need to be a bit of a detox period. But he is right about everybody that's become addicted to government spending. And he's most definitely right that the US doesn't have a revenue problem, they have a spending problem. But like I said, let's not forget his mandate is lower rates, a lower dollar, lower oil. He has a vision for America that's much different from his predecessor, Janet Yellen. And so just looking at the move and interest rate probabilities after today's job report and comments from Jay Powell, they actually pushed back the odds a little bit that we won't get the rate cut until June. But still a healthy 1 in 3 chance we could get it in May. But it's pretty much a lock that the Fed will stay on hold when they meet in a couple of weeks. They just want to make sure we don't get any quick and significant bump ups in CPI inflation from tariffs. And if CPI keeps coming down, and especially if the 2-year keeps coming down, we're looking like we're probably going to get a cut come Q2 or Q3. And there's a look at the price action in the 2-year, kind of looking like a bit of a bottom as well. Holding there at 4%, basically forecasting the Fed's next move will be down, but only by 25 basis points for the here and now. Price action in high yield bonds still holding up. Bond investors not too worried about economic growth by the looks of it. But like I said, there has been a bit of a flight out of USD assets, especially this week. But that trade could be a little stretched as well. Looking at international developed stock markets versus S&P 500, very stretched here in the short term. But like I said, a lot of big institutional investors, and some of them are very anti-Trump. They'll go around London, New York, Singapore, hold investor conferences where they'll speak down against his policies. And that's kind of the thing with markets. A lot of people do allow their politics to come into their investing decisions, which could be for the better or worse. Some people backing the new admin, some people betting against them, kind of similar to Elon Musk. And I guess we'll just have to wait and see who ends up picking the winning side. Because we're getting bombarded with headline after headline, inducing fear. American exceptionalism's over. Recession's coming. Stagflation. Where to hide right now? Investors should get defensive. Get into healthcare stocks. Even fixed income. Some even taking a step further saying, sorry, American firms, the AI trade has moved to China. No doubt China has thrown their hat in the race. Pretty much the only other country that can really give the States a run for its money. However, the fact is, Chinese AI models, chatbots, apps, they're never going to dominate in the American market, just like what we've seen with TikTok. There'll be a real battle for other markets. However, American companies will still dominate all the Western English-speaking markets. And I believe DeepSeek could very well be the Sputnik moment for American AI tech, referring to the space race between the Russians and Americans back in the 50s. Caused NASA to be born and prompted heavy investment and acceleration in space exploration and technology that then went quiet for decades, only recently been revamped thanks to the work done by SpaceX. But Chinese shares have been holding up remarkably well for what's said to be the start of a nasty global trade war, as we've also got the big fundamental tailwind of massive stimulus coming out of China that might be overwhelming the fears of tariffs and very well the actual material effects of tariffs versus the stimulus. Moving on to commodities, we've got crude oil finding its feet here today, ending high on a report the US plans to refill its strategic oil reserve, heavily depleted throughout the Biden years, taking us down to 40-year lows, something we've mentioned a few times. If oil gets cheap enough, good opportunity for the US government to re-up. And here's a look at the SPR. We can see there, coming into 2020, sitting at about 634 million barrels, got down to as low as 347 million barrels June 23, currently at about 393 million. But that's the same level it was back in the mid-80s. This was created after the oil embargo in the 70s. To be used in national emergencies, provide some cushion, along with adding strength to any political negotiations. They didn't have this. The states wouldn't have a cushion to lean back on. There's no oil, and the economy comes to a grinding halt. And there's a look at crude on the daily chart here. Maybe once again finding support in this big zone, 66 a barrel. Just hard to see a big trend developing in crude anytime soon. Pressures on both the upside and the downside, but this is a good level for inflation and for economic growth. Just like bond yields, if oil goes completely diving off a cliff, market could be pricing in low economic growth. However, just kind of bumping around here in the low end of the range. It's kind of just in those easy financial conditions level, in my opinion. Moving on, we just got news after close of Standard & Poor's doing their index rebalancing. The S&P 100, the S&P 500. Coming into the 100, Palantir, Intuitive Surgical, ServiceNow, getting deleted. Dow, Kraft, Ford, getting added to the S&P 500, DoorDash, TKO, Williams-Sonoma, and Expand Energy. They're replacing Borg Warner, Teleflex, Celanese, and FMC. And just looking at a few here, DoorDash getting a nice little move up after hours on that news. Algo's read it and priced it into the market within a second, I'm sure. And a few little bump ups for the others as well, TKO and Williams-Sonoma. Also in other news today, we've got the NASDAQ exchange applying to launch 24-hour trading Monday through Friday. There's already some overnight electronic exchanges set up that the brokers can hook into, Blue Ocean Technologies and such. So the market kind of already trades 24/5. And this will be another good thing for non-US traders. With more exchanges, there'll be more competition for our order flow, more bid-ask liquidity, tighter spreads. And there's a look at NASDAQ stock. I think it's kind of underrated and under-discussed. 42 billion market cap. And it's going out to a 3-month long-term chart. and going logarithmic. It's been a long-term winner. Like a lot of exchanges around the world, they have really good characteristics and can defend their businesses really well. And there's the company that owns the New York Stock Exchange, Intercontinental Exchange. And you've also got CME Group, another really good long-term winning stock. And looking even smoother on the charts, SIBO, huge growth in options. Been great for this company. And just looking at the daily there, still holding up pretty nicely actually throughout all this. We also just got news of the new Spider Bridgewater all-weather ETF hitting the market. Collaboration between State Street Global and the largest hedge fund in the world, Bridgewater, run by Ray Dalio. Famous for his all-weather strategy, a big proponent of diversification, and he made an interesting argument that always kind of stuck with me. Traditionally, the fund management industry, and you'll probably know this from your own pension funds, you have a conservative, balanced, growth, aggressive type different funds, and they'll change the risk reward by changing the allocation to stocks versus bonds, fixed income. So the aggressive funds will be like 80-90% stocks, 10% fixed income, and pretty much the opposite for conservative funds, mostly fixed income. Ray Dalio argued it was better to change your risk reward by always having a diversified portfolio and instead applying leverage to determine your risk reward, or what they call volatility targeting. So a conservative portfolio can be fully diversified with no leverage, aggressive the same asset mix, but with some leverage. And as all-weather strategy, also known as risk parity, kind of volatility targeting, mixing stocks, bonds, commodities, and gold. And this one's going to be active. But Ray Dalio did give a mixture for a permanent all-weather strategy. 30% in stocks, 15% in short, medium-term treasury bonds, 40% long-term bonds, 7.5% each in commodities and gold. And I just ran a back test on that portfolio. And this is why it's appealing to a lot of institutional investors, large money. You got the compounded annual growth rate, a bit over 6%, very low standard deviation at 7.9, and maximum drawdown of 19.8. Remember, stock markets, American included, they've had maximum drawdowns in excess of 50%, some markets 70, 80%. Simply too much for big money. And that's why an all-weather approach is a lot more suited to big money, and I guess older investors as well, who can't stomach a 50% drawdown. So this strategy basically just makes the bumps less bumpier. And there's the new ETF under the ticker ALLW. And not cheap either, 85 basis points management fee. And just looking at a few more charts here before we wrap it up, spread between high beta, low volatility stocks. 5th consecutive reversal signal. That's the most this indicator can give. Last time we did that was actually just back here in September. Marked the low in the spread for a few months. Pretty stretched here. Market looking to find a bottom. Kind of similar look to a lot of indices and sectors. And like I said, I think there is a reasonable chance we potentially may have hit the bottom today. However, I can't say that for sure because we're still in the dicey zone. We've still got the volatility term structure and backwardation, meaning the implied volatilities for short-term options are greater than a month out and even 3 and 6 months out. Telling me option dealers are still expecting high volatility next week. And like I showed you on this chart here, the S&P still didn't make a 10% correction yet, even though we have done on the other indices and sectors. And if it were, it typically happens very quickly. You can see all these sharp spikes down within 20 or 30 days after a 4% pullback or more has started. So for sure, I'm not ruling out the potential to make another low next week, but just looking at the Qs and the S&P 500, if we did, I think that would just add further weight to a tradable bottom, especially in the Russell 2000, come off so much more than the rest of the market here. I mean, for this big broad index, just this time last month, we're trading around 230. Here we are at 205. And typically sharp pullbacks like this can result in quick recoveries as well. But like I said, we won't know for sure we've made a bottom until the volatility market goes back into its normal state of contango. And so I get it with all the tariff uncertainty, why the market's nervous, why people are skeptical. But can you just imagine if we got a headline where the next week or the week after, the USA and Canada strike a brand new trade deal, lowering tariffs on US goods, or the US and Mexico, or what about the US and China strike a new trade deal that will help American companies export more goods to the world's second largest economy? What do you think might happen to the stock market on that news in an already financially easy environment? Like I said, we could wake up in Q2 with lower rates, plenty of liquidity, then all these tariff worries get resolved on the upside for American companies because bond yields seem to be finding their footing here as well. And looking out to next week, we got CPI inflation data coming on Wednesday. There'll be a big one. PPI Thursday, consumer sentiment Friday, and we've pretty much wrapped up back end of Q4 earnings. S&P coming in with growth of 17%. Pretty good if you ask me. But consumers and traders, as we can see with Bitcoin, are still uncertain, nervous, and anxious about everything that's going on. So plenty of markets still trying to find their footing here, and we'll see whether we can get that tradable low next week if we didn't make it already today. Otherwise, on some key stocks like Tesla and Nvidia, I think we're setting up pretty good buy the dip opportunities. As always, it's just my opinion. You don't have to agree with me. You're welcome to share your comments below this video. Other than that, have a relaxing weekend, and I'll see you again here come Monday night. Cheers.